வணக்கம். கோர்ஸ் கான்செப்ட்ஸ். Management accounting, the process of creating organization goals by identifying, measuring, analyzing, interpreting and communicating information to managers is called management or managerial accounting. It can be used to help managers make informed operational decisions. According to the Institute of Management Accountants, management accounting is a profession that involves partnering in management decision making, devising, planning, and performance management systems, and providing expertise in financial reporting and control to assist management in the formulation and implementation of an organization strategy. DuPont Analysis. The DuPont Analysis is also known as the DuPont Identity or DuPont Model. It is a framework for analyzing fundamental performance popularized by the DuPont Corporation. DuPont Analysis is a useful technique used to decompose the different drivers of return on equity. The decomposition of ROE allows investors to focus on the key metrics of financial performance individually to identify strengths and weaknesses. The calculation: DuPont analysis equal to net profit margin into AT into EM. Net profit margin equal to revenue divided by net income. AT refers asset turnover. Asset turnover equal to sales divided by average total assets. EM refers equity multiplier. Equity multiplier equal to average total assets divided by average shareholders equity. In other words, return on equity, that is ROE, equal to net income divided by average shareholders equity. Ratio analysis. Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying the financial statements such as the balance sheet and income statements. Accounting ratios are also called as financial ratios. It is the measure of relationships between figures indicated in the balance sheet and profit and loss account. Financial ratios are grouped into the following categories: liquidity ratios, leverage ratios, activity or efficiency ratios, profitability ratios, and market value ratios. Now, what is the meaning of liquidity ratios? A liquidity ratio is a type of financial ratio used to determine a company's ability to pay its short-term debt obligations. Liquidity ratio helps in measuring the cash sufficiency of an enterprise to pay off its short-term liabilities. A high liquidity ratio ensures that the company is in a good position to pay its creditors. The liquidity ratio of 2 or more is considered acceptable. They are current ratio, liquid or quick or acid test ratio, cash ratio or absolute liquid ratio, and the fourth one is basic defense ratio. Now we will see what are all the current assets. A current asset refers cash, a cash equivalent, or an item which can be converted into cash within 1 year mentioned in an entity's balance sheet. Current assets are all the assets of a company that are expected to be sold or used as a result of standard business operations over the next year. It includes 8 items: cash and cash equivalents, cash at bank, marketable securities or trade investments, account receivable, inventory stock, prepaid expenses, non trade receivables or accrued incomes or outstanding incomes. The eighth one is other current assets. Now we will see current liabilities. Current liabilities are the company's short term financial obligations that are due within 1 year or within a normal operating cycle. Current liabilities are settled by using current assets. The list of current liability is given below. 1. Accounts payable or trade payable, notes payable, current portion of long term debt, bank overdrafts, accrued expenses, income tax payable, unearned revenues, dividends payable, and short term debts. Now we will see what is current ratio. Current ratio equal to current assets divided by current liability. Current ratio, what is it? This is the ratio which measures the financial strength of the company. Generally, 2:1 is treated as the ideal ratio, but it depends on industry to industry. Net working capital equal to current assets minus current liability. Average current assets equal to aggregate assets for current year plus aggregate assets for preceding year divided by 2. Now we will see what is liquid or quick or acid test ratio. A liquid asset is an asset that can easily be converted into cash in a short amount of time. A liquid asset is a type of asset that can be rapidly converted into cash while keeping its market value. In simple terms, for calculation purpose, liquid assets equal to current assets minus stock and prepaid expenses. This ratio is the best measure of liquidity in the company. This ratio is more conservative than the current ratio. The quick asset is computed by adjusting current assets to eliminate those assets which are not in cash. So quick ratio equal to current assets minus inventory and prepaid expenses divided by current liabilities. Generally, 1:1 is treated as an ideal ratio. Now we will see what is the meaning of cash ratio or absolute liquid ratio. Absolute liquid assets include cash in hand, cash at bank, and marketable securities or temporary investments. This ratio measures the total liquidity available to the company. Absolute liquid ratio equal to cash in hand plus cash at bank plus marketable securities divided by current liabilities. Then we will see the basic defense ratio. This ratio measures the number of days a company can cover its cash expenses without the help of additional financing from the other sources. Basic defense ratio equal to cash plus receivables plus marketable securities divided by operating expenses plus interest plus taxes, the whole divided by 365. 365 refers the number of days in a year. Now, what is profitability ratios? Profitability ratio is used to evaluate the company's ability to generate income as compared to its expenses and other costs associated with the generation of incomes during a particular period. This ratio represents the final result of the company. They are return on equity, earnings per share, dividend per share, price earnings ratio, return on capital employed, return on assets, gross profit, and net profit ratios. Now, what is return on equity? This ratio measures profitability of equity fund invested in the company. It also measures how profitable owners' funds have been utilized to generate company's revenues. A high ratio indicates better performance. Calculation: profit after tax divided by net worth, where net worth equal to equity share capital and reserves and surplus. Earnings per share. This ratio measures profitability from the point of the ordinary shareholder. A high ratio indicates the better performance of the company. How it is calculated? Net profit divided by total number of shares outstanding. Dividend per share. This ratio measures the amount of dividend distributed by the company to the shareholders. The higher ratio indicates that the company has surplus cash. How this is calculated? Amount distributed to shareholders divided by number of shares outstanding. Price earning ratio. This ratio is used by the investor to check the undervalued and overvalued share price of the company. This ratio also indicates the earning of the company and payback period to the investors. How this is calculated? Market price share divided by earnings per share. That refers price earnings ratio. Return on capital employed. This ratio computes percentage return in the company on the funds invested in the business by its owners. A high ratio indicates better performance of the company. Calculation: net operating profit divided by capital employed into 100. Capital employed is the total equity share capital, reserves and surplus, debentures and long-term loans. Capital employed in shorter term equal to total assets minus current liability. Return on assets. This ratio measures the earning per rupee of assets invested in the company. A higher ratio represents better the performance of the company. Calculation: net profit divided by total assets. We'll see the gross profit ratio. This ratio measures the marginal profit of the company. This ratio is also used to measure the segment revenue. A higher ratio indicates the greater profit margin and it is good for the company. This is calculated as follows, that is gross profit divided by sales into 100. Gross profit equal to sales plus closing stock minus opening stock minus purchases and direct expenses. That is, from sales add closing stock, then deduct opening stock, purchases and direct expenses, we will get gross profit. Now, net profit. This ratio measures the overall profitability of company considering all direct as well as indirect cost. A higher ratio indicates a positive return for the performance of the company. Calculation: net profit divided by sales into 100. Net profit equal to gross profit plus indirect income minus indirect expenses. Average ratios. Leverage ratios. A leverage ratio is any one of several financial measurements that look at how much capital comes in the form of debt, that is loans, or assesses the ability of the company to meet its financial obligations. They are debt ratio, debt to equity ratio, debt to capital ratio, debt to EBITDA ratio, asset to equity ratio, operating leverage ratio. Now we will see what is debt ratio. Debt ratio of your company shows how much of your assets are financed. How this is calculated? Total debt divided by total assets. A debt ratio of 0.5 or less is good. Anything greater than 1 means your company has more liabilities than assets, which put the company in a high financial risk category. Getting finance is a challenging task for such situation. Debt to equity ratio. The debt to equity ratio compares the equity to debt of our company. Calculation: total debt divided by total equity. This ratio helps a lender to determine if company is financing operations with debt or equity. A high ratio indicates that the business owners may not be providing enough equity to fund a business. Hence, a ratio above 2 is considered risky. Debt to capital ratio. Calculation: debt divided by total capital. It is used by investors to determine the risk of investing in a company. If the debt to capital ratio is more than 1, it indicates the company's debt exceed its capital. Now, what is debt to EBITDA ratio? EBITDA stands for earnings before interest, tax, depreciation, and amortization. How this is calculated? Debt divided by EBITDA. This is helpful for companies to get a clear picture about their cash flow and their overall financial health. The low ratio indicates that the company has a debt load that is manageable. The acceptability of debt to EBITDA ratio will vary depends on the industry. For example, a ratio of a 7 could be okay for one company but too high for another. Next, we will see asset to equity ratio. What is asset to equity ratio? The asset to equity ratio is a measure of the total assets that are funded by shareholders. How this is calculated? Total asset divided by equity. The low ratio indicates that the company has conservative financing with low debt. If the ratio is high, it is unlikely to receive additional funding for the company. Operating leverage ratios. The operating leverage ratio gives an insight to the company's fixed and variable costs. It is related to cost accounting. It indicates how a business uses fixed cost to turn into a profit. A high operating leverage ratio indicates a high percentage of fixed cost and low variable cost. Degree of operating leverage DOL equal to percentage change in EBIT divided by percentage change in sales. EBIT refers earnings before interest and tax. Now we will see activity or efficiency ratios. Efficiency ratios measure a company's ability to use its assets and manage its liabilities effectively in the current period or in the short term. These ratios measure how efficiently a company uses its assets to generate revenue and its ability to manage those assets. Now we will see one by one. 1. Accounts receivable turnover. The accounts receivable turnover is used to measure the efficiency of the company's credit policies. The too low accounts receivable turnover may show that the company is either finding it hard to collect debts from customers or that is granting credit too easily. All factors being equal, a high accounts turnover is recommended. Accounts receivable turnover equal to net annual credit sales divided by average accounts receivable. Inventory ratio. Inventory turnover can help you to determine how well you are managing your company's inventory levels. If the figure is too low, it means that you are overbuilding or overstocking the inventory, or that you are having problems pushing sales to consumers. Hence, the higher the inventory turnover, the better your inventory management policy is. It is measured as follows: inventory turnover equal to cost of sales divided by average inventory. Accounts payable turnover. This ratio measures whether the company has sufficient resources to pay its immediate bills. If the figure is high, it shows that the company is not getting healthy payment terms from the suppliers. It is measured as follows: accounts payable turnover equal to net credit purchase divided by average accounts payable. The asset turnover ratio. It measures the efficiency of a company's assets in generating revenue or sales. It compares dollar amount of sales, that is revenues, to its total assets as an annualized percentage. Asset turnover ratio equal to net sales or revenue divided by average total assets. Market value ratios. They are used to evaluate the current share price of a publicly held company's stock. These ratios are employed by current and potential investors to determine whether a company's shares are overpriced or underpriced. The most common market value ratios are noted below. 1. Book value per share. This is used to benchmark to see if the market value per share is higher or lower which can be used as the basis for decision to buy or sell shares. How it is calculated? Book value per share equal to aggregate amount of stockholders equity divided by number of shares outstanding. Then dividend yield. Dividend yield equal to total dividends paid per year divided by market price of the stock. This is the return on investment to investors if they were to buy the shares at the current market price. Earnings per share. Earnings per share equal to reported earnings divided by total number of shares outstanding. There are several variations on this calculation. This measurement does not reflect the market price of a company's share in any way, but can be used by investors to derive the price they think the shares are worth. Market value per share. Market value per share equal to price per share divided by earnings per share. This reveals the value that the market currently assigns to each share of a company's stock. Price earnings ratio. Price earnings ratio equal to market price per share divided by earnings per share. It is used to evaluate whether the shares are overpriced or underpriced comparing to the same ratio results of competing companies.